Welcome to the IMFG market update for the final quarter of 2025. Steve, it was an interesting quarter. Some great returns across the market, but there was a bit of volatility. It might be an indicator of some things to come as we start 2026.
Look, that's right, John. As you said, great returns over the whole year, and we'll look at that at the end. But in the quarter, very interesting. It had a few wobbles in it. Let's have a look at this chart, John. It shows the Australian and the US market plotted on a day-by-day basis over the year. Now, you can see when tariffs hit in early April, but you can see when the tariffs were put on pause, an instant bounce back. And from that time, markets were sailing to record highs by the end of October. And then it all went a little bit pear-shaped. There was a fair bit of volatility going on. And you can really see here, John, that the US and the Australian market, which are pretty well correlated over the course of the year, really have got that, diverging fortunes in the last quarter. So overall, Australia for the quarter, -1%, although it's got a good return for the year of 10.3%. That's above its long-term average, so nothing to complain about there. The US, on the other hand, not a bad quarter, 2.7%, but once again, a really strong year for US investors.
Now that's the share market. What about the bond market? Because I saw a few wobbles in the bond market as well.
Absolutely right. When you look at this chart, it actually looks remarkably similar to the last chart. So here I'm showing the US and Australian 10-year yields, and they've been correlated pretty much the last 5 years. But once again, John, you see in the last quarter that separation, that diverging fortune between Australian and US yields. Now, yields are the biggest driver of your bond returns, and so you can see in the numbers we've got there that the Australian bond market, slightly negative return, -1.2% for the quarter, a positive return for the year, but a much stronger return for the US bond market, positive in the quarter and 4.7% for the year. So that's just a reflection when yields go up, as in Australia, bond prices go down. But in the US, the yields have stayed pretty static for the quarter, but come down over the course of the year.
Now I assume that divergence has got something to do with interest rate expectations?
John, that is spot on. In fact, it's actually the story, because 10-year yields are kind of projecting what the market thinks about interest rates going forward. And you can see that Australia was going up, while the US was staying flat or going down a little bit. So when we show you the interest rate chart here, this is from 2021. That's when interest rates were zero. Do you remember that?
Yes.
And then, of course, particularly in the US, they bounced up pretty high, up to over 5%. Pretty fast. Australia, we lagged a little bit in raising rates, so it's probably no surprise that we're a little bit slower in bringing them down now. But you can see this convergence of the rates. But what the bond yields are telling us is that the US is expected to continue to cut rates into next year and even the year after. But in Australia, the bond market is telling us that that's kind of the end of this interest rate cycle. In other words, rates are going to stay relatively flat for most of next year, and the next interest rate movement in Australia is probably going to be upwards.
So for 2026, what can we expect in markets? More volatility?
So I think that's right, John. When we looked at the wobbles in November, why did it wobble? It all had to do with the US. Over there is that people are still worried about the amount of money being spent on artificial intelligence and the return that it'll get from it. On top of that, US valuations are stretched. That market's been going up 20% a year for the last 3 years. But inflation remains sticky and employment is going down. So the economy is in this very awkward situation for the Federal Reserve to navigate. So the concerns that made the market wobble in November are still there and will probably dictate a little bit the way markets behave. Now, that's an economic perspective, John. We don't know what markets will do. The financial markets and economics are two completely different things. Even though they should work in tandem, they don't. John, why don't we finish by just having a look at the returns that an Australian investor would have got in a diversified portfolio. So when you look at this chart, you can see on the left-hand side is Australia. We've already mentioned that, minus 1% for the quarter and up over 10% for the year. Pretty good. When you go to the developed markets, which is sort of dominated by the US, but this is now in Aussie dollars, they're up just over 12% for the year, another great return, greater than average. And emerging markets, which have been a little bit of a laggard over the last couple of years, they're now looking really good, up about 24% over the course of the year. So all in all, John, if you're in a diversified portfolio, as we are in the IMFG portfolios, you've had another really strong year of returns. And of course, we're well positioned as we move into the future.
That's great. Thanks so much, Steve. We'll see you at the next quarterly update.
Terrific. Thank you, John.